Good day, I'm Maria and I will explain the introduction of provision for contingencies and to define what is provision. Introduction of provision for contingencies. The purpose of this topic is to know how provision and contingencies are addressed in accounting. So let's say a washing machine manufacturer who offers a 1-year warranty on its product. If something goes wrong during the warranty period, the company will either repair or replace the machine. So consider it that the company offers a 1-year warranty and assume a potential liability every time they are sold. By the ideal, the corporate might record a warranty-related expense only when resources are expended to service a warranty. According to the matching principle, any cost incurred to create revenue must be matched against the revenue generated in the period of time. Companies should not understate their responsibilities according to conservatism. Defining provision. IFRS has one specific standard that deals generally with how companies should account for provision. According to IFRS, a company should recognize provision only when the entity has a present obligation to transfer economic benefits as a result of past events. It, it is a probable events. It is probable that such a transfer will be required to settle obligation, and a reliable estimate of amount of the obligation can be made. Provision represent funds put aside by a company to cover anticipated losses in the future. In the other words, provision is a liability of uncertain timing and amount. Provision and contingencies are liabilities arising from past. We have to pay future, and it is a known yet in prices liabilities. We know it exists, but we may not know exactly when it will have to be paid or how much. Provision has to be made when each of the following occurs. There is a present obligation, a duty to make a future payment resulting from past event. It is probable that there will be a future cost, then the amount of obligation can be made reliable estimated.
Measurement of provisions. The amount recognized as a provision must be the best estimate of the expenditure required to settle the present obligation at the balance sheet date IAS 37:36. The estimates of outcome and financial effect are determined by the judgment of the entity's management, supplemented by experience of similar transactions and, in some cases, reports from independent experts. The evidence considered should include any additional evidence provided by events after the balance sheet date as required in IAS 10, IAS 37:38. Risks and uncertainties that surrounds events and circumstances are taken into account when reaching the best estimate of a provision. Care should be taken to ensure that expenses and liabilities are not understated. However, IAS 37:43 also cautions against creating an excessive number of provisions or overstating liabilities due to uncertainty. For each class of provision, an entity shall disclose the carrying amount of the beginning and end of the period. Additional provisions made in the period, including increases to existing provisions. Amount used, for example, incurred and charged against the provision during the period. Unused amount reversed during the period, and the increase during the period in the discounted amount arising from the passage of time and the effect of any change in the discount rate. Comparative information is not required. An entity shall disclose the following for each class of provision: a brief description of the nature of the obligation and the expected timing of any resulting outflows of economic benefits, an indication of the uncertainties about the amount of timing of those outflows where necessary to provide adequate information. An entity shall disclose the major assumptions made concerning future events as addressed in paragraph 48 and the amount of any expected reimbursement, stating the amount of any asset that has been recognized for the expected reimbursement. Unless the possibility of any outflow in settlement is remote, an entity shall disclose for each classes of contingent liability and the end of the reporting period a brief description of the nature of the liability and where practicable an estimated of its financial effect measured under an indication of the uncertainties relating to the amount of timing of any outflow and the possibility of any reimbursement. Thank you.
Good day, my name is Marjikel Casamis. What is contingent liability? A contingent liability is defined as a liability which may arise depending on the outcome of a specific event. It is a possible obligation which may or may not arise depending on how a future event unfolds. A contingent liability is recorded when it can be estimated, else it should be disclosed. A contingent liability is a liability or a potential loss that may occur in the future depending on the outcome of a specific event. Potential lawsuit, product warranties, and pending investigation are some examples of contingent liability. If the amount can be estimated, the company sets aside that amount separately to be paid out when the liability arises. Contingent liability as a term does not apply only to companies but to individuals as well. For example, if you took an educational loan of Rs 10 million from your bank to fund your child's higher studies, that amount could well become a contingent liability if your child fails to make a monthly payment after getting a job. You might have to pay the amount because you have taken the loan from your bank. Let's understand contingent liability from a company point of view. Your company might be in the middle of a lawsuit and your lawyer thinks that the other party has a strong case which could potentially lead to damages worth Rs 10 crore. In that case, the company would book that amount as a contingent liability on its balance sheet. On the other hand, if the lawyer or the legal department thinks that the other party does not have a very strong case in hand, they would advise the firm not to make any provision of a contingent liability. When the probability of a contingent liability is low, then is no journal or even a disclosure is required in the books of accounts. And the last is contingent asset. What is a contingent asset? A contingent asset is a potential economic benefit that is dependent on some future events, largely out of a company's control. A contingent asset is thus also known as potential asset. Not knowing for certain whether these gains will materialize or being able to determine their precise economic value means this asset cannot be recorded on the balance sheet. However, they can be reported in the accompanying footnotes of financial statement provided that certain conditions are met. A contingent asset becomes a realized asset recordable on the balance sheet when the realization of cash flow associated with it becomes relatively certain. In this case, the asset is recognized in the period when the change in status occurs. Contingent asset may arise due to the economic value being unknown. Alternatively, they might occur due to uncertainty relating to the outcome of an event in which an asset may be created. A contingent asset appears because of the previous event, but the entirety of all asset information will not be collected until future events happen. Example of contingent assets. A company involved in a lawsuit that expects to receive compensation has a contingent asset because of the outcome of the case is not yet known and the dollar amount is yet to be determined. Let's say company ABC has filed a lawsuit against company XYZ for infringing a patent. If there is a decent chance that company ABC will win the case, it has a contingent asset. This potential asset will generally be disclosed in its financial statement, but not recorded as an asset until the lawsuit is settled. Based on this same example, company XYZ would need to disclose a potential contingent liability in its notes and then later record it in its accounts should it lose the lawsuit and be ordered to pay damages. Contingent assets also crop up when companies expect to receive money through the use of warranty. Other examples include benefits to be received from an estate or other court settlement. Anticipated mergers and acquisitions are to be disclosed in the financial statement.